Today we're going to talk about residential subdivisions and development financing for residential subdivisions. When most people think about a subdivision, they figure a developer buys some land and develops it, gets it approved, and builds houses. So when you talk about financing, there are many different facets to doing something like that. It's not just buy the land, finance it, develop it, finance it, and build the houses, finance it. There can be many things in between, and many times where a developer needs an input of money or needs to arrange for financing. For example, generally, when a developer buys some land and then now develops it, that piece of land could have 3 or 4 components. It could be a residential type in the center of it, and maybe it fronts onto a main street. You could have commercial, so now you need different type of financing for commercial. So what happens, and this is, I want to talk about a challenge. So a challenge that happens sometimes with a developer, because there are so many different facets in terms of getting money and developing a property, there are times where a developer needs money, but he hasn't necessarily brought it to a certain level where he can go to a large construction lender. So for instance, we have a challenge where we help somebody. We had a developer that bought some land to develop, so he buys the raw land for $2.1 million, and at the time of acquisition, he gets a mortgage of $1.1 million. Okay, fine. Now he starts putting his own money into it to develop it. Now, as part of getting ready for construction financing, we had to do an appraisal. So an appraisal was done to say, what is this property going to be worth? Not when it's developed, but when he has the approvals in place to develop. So he's increased the value just by getting all the approvals from the municipality in place. So now an appraiser said, once he has approvals in place, so it's shovel ready to do something, it's going to be worth $5.5 million. So now we have a developer that buys for 2.1. He starts sinking his money into it in order to get it developed. Now in this case, what happened was a developer was starting to get low on funds. So now in terms of using that $5.5 million appraisal, yes, it's out there and we have a copy of it, but it's telling us that's what it's going to be worth when he gets it approved. So right now he really has it half approved, which doesn't really change the value of the property. But it would change the value to a property to a development lender or a financer of development land that understands. So he knows, and he has some faith in the developer, that even though he's still at the stage of maybe midway through the development, he has added some value. So most lenders want to go back to the 2.1 and lend against that. So we were able to, in this case, give him a type of a bridge. So we had a lender lend the developer based on that he paid 2.1 million, but he also increased some sort of intrinsic value in the property, although not yet defined, but just some intrinsic value. So we were able to get him another $400,000, and it's a bridge type loan. So we lend $400,000. Now the developer was able to continue with his development, whatever studies, whatever he had to do to get to the point where he has an approval in place. Now in this particular case, he's completed. He has a plan of subdivision in place. Now the $5.5 million value kicks in. Now a lender, and we have a construction lender that's going to do that deal, can lend him against the $5.5 million and lend him the development money to develop that land. Of course, once he does that, then now we're going to go to another step where now we're going to lend him money, or we're going to help him borrow money to build the houses. If you need more information, give me a call or send me an email. If you get my voicemail, leave your name, phone number, and the best time for me to call. Your call is important to me, and I will call you back. Look forward to speaking with you. Take care.